So a lot of things we're going to go over in this video. I'm going to timestamp it down below. I have requests. I have individual stocks that I think are getting undervalued. But the first thing I really want to start off with is what is taking place with Deadpool and Wolverine. Over the weekend, Disney's and Marvel's Deadpool Wolverine became the second R-rated movie to top $1 billion in global box office sales. Now, I want to point a few things out here. Disney is now profitable in streaming. They're making blockbuster movies. And over the weekend, they dropped a bomb. They are expanding all the parks. They're adding a new Villains Land in Magic Kingdom. They're adding a Hercules musical in London, Greatest Showman musical, many more rides on the horizon, and yet the stock is trading at pandemic lows. So let me recap here. Disney is trading near pandemic lows when they're making blockbuster movies, they're profitable in streaming, they're one of the top streaming subscribers, they're expanding their parks, and this is why I think Disney is actually tremendously undervalued. Along with Disney, we're going to talk about Ally Financial. We're also going to talk about Goldman Sachs BDC Inc., a specific fund that I want to bring to your attention. Of course, this is all my opinion. I always recommend just dollar cost averaging into a broadly diversified index. Set it and forget it. But on this channel, we do fundamental analysis for individual stocks. So let's get into it. So over the last 5 years, we've seen dismal returns when it comes to Disney, down 37.8%. And this hit a high of over $200 a share, now cut in half at $86 a share and hit a 52-week low of $78. Now, while that stock price is absolutely collapsing, the interesting thing is Disney is getting profitable on streaming, and they're also growing top-line revenue, going from $65 billion to now $90 billion of top-line revenue. And when we think about the top players in streaming, obviously we all know Netflix is winning this game. They're number one with 269 million subscribers. Number two is sitting with Amazon with 200 plus million subscribers. But guess who's now profitable and in third place? And that's going to be Disney with 153.6 million people that are paying every month to watch Disney products. This tells me that with Disney's price coming down, the revenue going up, and actually fundamentals picking up, they're growing the parks, they're adding cruise lines, they're adding hotels, they're adding restaurants, they're making blockbuster movies, but yet the stock is going down, to me tells me that this is the cheapest that Disney has ever been, and could be a buying opportunity. Now, I already did a video on Disney. I'll leave that linked above, but I just wanted to touch on this one stock before we get into Ally Financial. Now, over the last 5 years, Ally Financial's basically traded sideways here. It's up about 26% over the last 5 years, pays right around a 3% dividend, and it's trading at 17 times earnings. For credit cards, I like to use forward PEs, EBITDA, and free cash flow analysis. When we talk about banks and people that actually hold money and or lend money, we like to look at book value versus that company and how fast they're growing that book value. So we're going to do two different analysis on two different financial institutes, so hopefully you guys like and consider subscribing as we get into Ally Financial. Now, this was a call out by one of my subscribers. This is not a company I really follow, so you guys are going to see exactly what my mindset is when I go into a company that I really don't know anything about. And this is why Ally Financial has basically traded sideways. On this channel, we talk about it all the time. Price action is always going to follow earnings and earnings growth. And as we can see here, Ally Financial was doing $6 billion in revenue and earnings was starting to grow, revenue was growing, and then we're back to where we basically started, doing right around $7 billion in revenue. And we can see that earnings are actually tailing off. So the efficiency within the business is becoming a problem here. Right off the bat, I'm starting to see some red flags, and I'm starting to see why the company's not trading for a premium when we kind of compare them to their peers. Sentiment around the stock is pretty interesting here. We have a low of $31, a high of $51, which I look at, and this is pretty much a tight range. We normally don't see this tight of a range, but with Ally Financial, maybe we're looking at basically fair market value at these levels. So the first step I would actually like to do is take a look at where earnings projections are going to come in here. For 2025, they're projected to do $5.77. Over the last couple of years, the stock's traded anywhere between 7 times to right around, call it 10 times forward earnings if we average it out. We'll put a little buffer in there and just say they earn $5.60. We multiply that times 8. We get right around a $44.80 stock price. And so when we're looking at total returns, that's something we want to incorporate. So this company pays nearly a 3% dividend. And over the last 7 years, they've paid that dividend, but they haven't been raising that dividend consistently. So that's something to keep in the back of your mind as well. So we look at a MasterCard trading at 25, 26 times and industry standards sitting at 11, 12 times multiple EBITDA. I think anywhere between a 13, 14 multiple for a company like Ally Financial makes sense. This is a company that has good free cash flow, nice balance sheet. and it's projected to grow here, so we might be able to pay a little bit of a premium. So we got a lot of different prices here. From a forward PE standpoint, we're looking at right around $45 to maybe $50 a share. From a DCF model, we're looking at $61 a share. A multiple of EBITDA, looking for a double-digit rate of return with dividends reinvested, we need to be buying at around $34 a share. I do think Ally is pretty interesting at these levels. I would like to see it break below $40 a share and get close to the mid 30s, and that's where I think the risk versus reward makes a lot of sense with those dividends reinvested. I do think you'll get an outsized rate of return on a company like Ally Financial. Once again, guys, this is just my opinion, so take it for whatever it's worth, but Ally Financial is pretty interesting at these levels. Would like to see it dip another 10% personally. You would also be getting a higher dividend rate at that point in time as well, which is now going to lead us to a massive dividend yield here. A company that's paying right now 45 cents a share, and the stock is trading at $13.76. We can see here that we have a low of $12 and a high of $15. Once again, a tight range. I really like this below $14 a share, and I'm going to get into why that is. But if we divide that quarterly dividend of 45 cents divided by $13.75, every quarter you're getting nearly 3.3%. We multiply that by 4 quarters in a year. This thing is paying over a 13% dividend yield right now. Now, of course, dividend yields are scary, guys, because as dividend yields get higher, that means the stock price is falling for a reason. But we can see revenues growing and earnings are kind of staying flat here. So this is about where I think fair market is for the company. So fair value for the company is probably sitting right around $13.65. Where book value would be right around $13.65. So it's trading for a little bit of a premium here. And that's why I said anything under $14 makes a lot of sense. If you can get this thing in the $12 range, I think you have a pretty outsized rate of return when we factor in that over 13% dividend yield that comes along with it. Now, this is a company that really doesn't grow its dividend. It's been paying that dividend for 8 years, and we're going to talk a little bit about what this company does. This is a really niche fund that focuses on distributing liquidity to middle market businesses, companies that do between $10 to $75 million of EBITDA, and the objective of this fund is to create income for investors. So this is really like a bond fund, and there's definitely risks here. When we look at what it's traded for, this is a company that's probably not going to grow earnings tremendously. It's going to pay that 12 to 13% dividend yield, and you're probably not going to see a lot of stock appreciation here. But I think as we watch the Feds cut rates and yields come down, this is going to be one that's probably going to set up pretty interesting. As rates come down and we look for more yield type of equities out there and something that doesn't have a lot of beta, I really think this fits in the wheelhouse and is a different alternative to maybe like your REITs. So when we go on the longer term chart, we obviously broke this very, very important trend line that was in play since. So when we take a look at the October lows, this trend line was in place and it's touched it many, many times and recently broke through it. And this is where I said, I believe we're going to start forming that head and shoulders pattern. So let's zoom in on this one area here. And this one trend line is actually telling me, I believe, everything we need to know about market volatility that's coming ahead here. As I stated before, ladies and gentlemen, and I basically stated it here, that we're probably going to break this trend line and form a right shoulder. And that's exactly what I believe is taking place right now. I think we're going to come up to this trend line, start curving out a right shoulder, and this is where the problems are going to start coming as we get into the end of this year and the beginning of 2025. We can see that we basically have a left shoulder that's formulated here, a head that's formulated here, and we're getting that right shoulder pattern that's coming back up. And I think it's going to trick a lot of people into a fake rally. So when I look at this, I think we have a rally somewhere in the next few weeks, possibly next few months. But as we get latter into the end of the year, I do think there's going to be some problems here with that right shoulder pattern starting to formulate, and I do think we will possibly see some pretty volatility, and I do think we'll see some substantial volatility as the year progresses and we go into 2025. As most of you know, I believe we will be in some sort of confirmed recession by the middle to the end of 2025. As always, guys, just my opinions, always keeping you up to date, and if my opinions change, I will let you know. Hopefully you guys enjoyed, and we will see you in the next one.